Hello and welcome to AI Market News by LM. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at our own discretion. Greetings. Today we're embarking on really a crucial deep dive into the swirling currents of global financial markets. Our mission is to cut through all the noise, extracting the essential insights from the latest economic news, earnings reports, and shifts in market sentiment. We're specifically tailoring this discussion for those of us closely tracking US and European financial landscapes. We'll be unpacking everything from key global currency pairs like the USD and USGGPY to major US equity markets, the S&P 500, NASDAQ, and Dow. And of course, the crucial macroeconomic indicators that are shaping our investment decisions right now. Think of this as our shortcut to truly understanding not just what's happening, but why it matters and maybe what we should be considering as we look ahead.
Absolutely. Our goal is to provide a concise yet thoroughly structured summary. We aim to equip us all with the context needed for critical thinking, moving beyond mere headlines to grasp the underlying forces at play in our, rapidly evolving financial world. It's about connecting those dots for us.
Okay, let's unpack this overall market picture then, just a snapshot of where we stand. For a while now, we've seen U.S. equity markets in a, remarkably strong position, almost relentlessly pushing higher. The S&P 500, NASDAQ, Dow Jones, they've certainly been making notable moves. But the real question is, what's driving this? And what subtle shifts might be happening beneath the surface?
What's truly fascinating here, and something we should pay close attention to, is that while the S&P 500 recently hit a new record high, climbing 0.24% to 6,408.40, and the tech-heavy NASDAQ also gained 0.21% to 21,598.14, we're observing some intriguing underlying shifts. For instance, the Russell 2000.
Right, the small cap index.
Exactly. Representing small cap stocks, those smaller, often more domestically focused companies, it has actually outperformed the S&P 500.
Really, for how long?
For a third consecutive week. Now, this isn't just a quirky data point, it's a critical signal. It immediately makes us wonder, are we starting to see a broader rotation in the market? Beyond just the mega cap tech names that have dominated for so long.
Interesting.
For investors, this could mean that the rising tide lifts all boats era, especially for big tech, might be shifting. It suggests maybe a need for us to reevaluate portfolio concentration and think about what's driving these smaller companies. We're also closely monitoring sentiment indicators like the Fear and Greed Index,
Yes.
which, as seen in our sources, has been hovering in greed territory. We have to recognize their often contrarian role in market dynamics.
That Russell 2000 outperformance really does grab our attention. It suggests maybe a broadening of the market rally. We've certainly seen a broad-based move with, 343 stocks gaining in the S&P 500, led by traditional bellwethers like energy and tech. But the discussion around a significant rotation into value stocks from large-cap tech may be being potentially more impactful than future rate cuts. That idea, noted by a JP Morgan specialist in various news commentary, is definitely something for us to consider for our own portfolios. It challenges the prevailing narrative, doesn't it? Suggests a deeper structural change might be underway.
It absolutely does. And this rotation hypothesis, it gains more traction when we look at capital flows. Are investors truly diversifying, or is this just a temporary blip? The sustained outperformance of small caps, they're often more sensitive to domestic economic conditions.
Right.
It could signal a renewed confidence in the broader economy, maybe moving beyond just the AI hype into more traditional sectors. It suggests that perhaps the market is less concentrated in just a few giants than it was, say, 6 months ago.
Okay, so that's the broader picture. Now let's turn our attention to the company that's truly been dominating headlines and, sparking intense debate. NVIDIA. Their earnings report, released after market close on August 27, 2025, arguably the most anticipated event of the week. Expectations were incredibly high, especially after the stock had already gained, a staggering 90% in just 2 months leading up to the announcement. The pressure was immense.
A key point for us to understand here is NVIDIA's sheer weight in the S&P 500. It stands at over 8%.
Over 8%.
Yeah. This means its performance can single-handedly sway the entire index, making its earnings a kind of bellwether for the broader tech sector. However, history also shows us, and this is important, that NVIDIA's stock performance the day after earnings has diverged from the S&P 500 about half the time.
Wow.
We saw an example of this in the past where a solid earnings beat wasn't quite a blowout, causing NVIDIA stock to fall over 6% while the S&P 500 500 remained unchanged. It just highlights the razor-thin margin for error when expectations are, well, so elevated.
So with all that anticipation, what did their latest numbers actually reveal? And maybe more importantly, did they meet those sky-high expectations, or are we seeing a slight reality check for the AI darling?
Well, based on the prepared resources, NVIDIA reported Q2 earnings per share, or EPS.
Per share, yeah.
Right, simply profit divided by outstanding shares of $0.50 per share. Their revenue came in at a robust $46.74 billion. That's a remarkable 56% jump year over year.
56% growth is still huge.
It is. And digging deeper, data center revenue, which is their core AI business, was specifically up 56% to $41.1 billion. Their adjusted gross margins were also very strong at 73%, indicating pretty healthy profitability.
Okay, sounds good so far.
Right, but then we get to the forecast. For Q3, they forecasted revenue of $54 billion, plus or minus 2%. Now, while this was broadly in line with street expectations of around $53.46 billion, some analysts had much higher projections, whisper numbers closer to $60 billion. So that gap meant the forecast felt like a slight disappointment to some, and that led to a dip in the stock post-earnings. This deceleration, even from these astronomical growth rates, it sort of signals that investors are looking for continuous accelerating momentum. Any hint of slowing down is met with skepticism.
A slight disappointment after such massive growth. That's a fascinating turn of phrase, isn't it?
Yeah.
What does that signal about market sentiment for NVIDIA, or maybe even the broader AI boom? Are investors starting to look for more than just raw growth figures?
It definitely suggests a maturing of the narrative, I think. At least in terms of market expectations. We're moving beyond the initial euphoria of, any growth is good growth,
right,
to a more nuanced assessment. Investors are starting to differentiate between raw demand and sustainable accelerating growth. It also highlights that the market is acutely aware of the external pressures on NVIDIA,
right,
particularly concerning its access to key markets.
And that leads us directly to a key factor weighing on NVIDIA's future trajectory, the China market.
Yeah.
What's the latest on their ability to sell chips there, especially given the ongoing geopolitical tensions?
Yeah, geopolitics here are paramount. NVIDIA reported no H20 chip sales to China-based customers in Q2.
Zero. Wow.
Zero. That's a significant data point. The company's CEO, Jensen Huang, is actively lobbying the U.S. government for permission to sell their more advanced Blackwell chips to China, citing a potential $50 billion opportunity. This really highlights just how critical the Chinese market is to their long-term revenue growth.
50 billion is a huge number.
It is. However, we're also seeing concerns from within the U.S. government about a potential 15% cut in revenue for the U.S. Treasury if export restrictions are eased. And that could also lead to legal risks for NVIDIA if they navigate these waters incorrectly. Meanwhile, China is vigorously pushing for self-sufficiency in chip manufacturing.
Right, their own domestic champions.
Exactly. Homegrown chip makers like Cambricon are seeing surges in their shares. This means even if NVIDIA cannot sell its top-tier chips, Chinese companies are finding ways to build competitive AI models with not as good but more cost-effective local chips, as demonstrated by the success of models like DeepSeek. It creates this very complex, almost dual-track AI development landscape globally.
It's almost a tech Cold War playing out, isn't it?
It certainly has that feel sometimes.
Beyond just the chips themselves, how is the AI story broadening out? Are we seeing it move into real-world, tangible applications that we can actually, see and use?
Yes, and the AI investment cycle is unquestionably still accelerating. That's the exciting part for us. Major players like Microsoft, Meta, Amazon, Google, they've all revised their AI infrastructure spending higher for this year and the next. That signals continued belief in the technology's transformative power.
So the big guys are still spending big.
They are. But we're also seeing the picks and shovels phase evolving into tangible use cases. Think of Miso Robotics, for instance. They're using NVIDIA's tech for applied AI in commercial kitchens.
Robots flipping burgers.
Kind of, yeah. It highlights how labor shortages are driving automation, moving AI from abstract data centers into practical everyday industries. We're also seeing initial steps in consumer AI, like AI-enabled wearables. Raw Kids smart glasses offering real-time translation and accessibility solutions.
Okay, that's useful.
It's no longer just about the underlying tech, it's about what that tech enables in our daily lives and industries.
That's a fascinating pivot from the foundational technology to its widespread application. What does this acceleration in AI mean for the workforce, especially for those of us navigating career changes or thinking about future skills?
Well, while there's a lot of justifiable hype, this transformation is inherently long-term. We are already seeing disruption, particularly in entry-level roles.
Like where?
Software development, customer service. AI tools are getting more sophisticated there. Yet, paradoxically, industries like hospitality continue to face acute labor shortages. It indicates a mismatch, really, in skills and demand. On the other hand, the freelance market for highly skilled professionals in areas like machine learning and AI ethics is booming. Many are choosing flexibility over traditional employment. And there's a compelling MIT report suggesting that only 5% of companies are truly realizing significant value from their AI investments yet.
Only 5%.
Just 5. This is a crucial insight. It tells us the real bottleneck isn't the technology itself, but its effective integration and strategic application. This implies a massive untapped market for consultants, specialized AI service providers, companies that can bridge that implementation gap. It's like a new picks and shovels play, perhaps, for the next wave of AI adoption. That could be a significant opportunity for us.
So the foundational models are here, but the widespread value-generating application is still in its early innings, as they say. It's almost a race to figure out how to best implement these tools. Okay, let's pull back the lens a bit. We've seen how specific tech giants are reshaping the market, but it's crucial to remember these individual company stories unfold against a much larger, more powerful economic backdrop. So what are the overarching macroeconomic currents that we absolutely need to understand right now? Let's maybe start with interest rates and central bank policies.
Yeah, a key consideration here is the US dollar. It's currently under some pressure, primarily due to growing expectations for a September rate cut by the Federal Reserve. The Fed's target rate currently stands at 4.50%, with its next meeting on September 17, 2025. This anticipation is heavily influencing global currency markets.
Right, the Fed looms large.
Always. We're also observing a steepening of the yield curve. That's when long-term bond yields rise faster than short-term ones, often signaling expectations of stronger economic growth or, well, inflation down the road. Specifically, the 30-year yield approached 4.96% before pulling back a bit, and the 10-year versus 2-year yield spread recently increased by over 15%.
Okay, so the bond market is pricing in something.
Exactly. Complex expectations around future rate movements and potential economic shifts. This also directly impacts global currency pairs. The USD, for instance, might see upward pressure if the dollar weakens further on those rate cut expectations. Meanwhile, the USD-JPY relationship is particularly sensitive to what the Bank of Japan does with its yield curve control.
And other central banks.
Of course, they're also at play. The European Central Bank, the ECB, is at 2.15% with their next meeting September 11, 2025. The Bank of Japan, BOJ, at 0.50%, meeting September 19, 2025. Interestingly, weak demand for short-term Japanese government bonds suggests investors anticipate the BOJ may raise rates soon. That could significantly impact the USD-JPY pair.
So global interest rate divergence influencing major currency pairs like Euro USD and USD-JPY. What about the persistent issue of global trade tensions? How are these disputes impacting the broader economy and our, interconnected supply chains?
Trade wars, well, they continue to be a significant factor in global economics. Look at India's exports to the U.S., valued at $87.4 billion in 2024, now facing 50% U.S. tariffs.
50%.
Yeah. And this isn't just about India. It's causing buyers to shift to neighboring countries like Bangladesh and Vietnam. It's fundamentally altering established trade routes and supply chain reliability.
So realignment's happening.
Definitely. Conversely, the European Union is fast-tracking legislation to remove tariffs on U.S. industrial goods, specifically aiming to meet U.S. demands to lower auto duties. That move highlights a strategic attempt to maybe de-escalate tensions and foster closer trade ties. Mexico is also planning to increase tariffs on Chinese imports, cars, textiles, aligning with U.S. pressure to reduce reliance on Chinese manufacturing.
Following the U.S. lead there.
Seems like it. And even Japan's top trade negotiator canceled a U.S. visit, specifically to press for lower car tariffs. That indicates unresolved issues despite earlier agreements. What's critical here is that these aren't isolated incidents. They're symptoms of a global reevaluation of supply chains and strategic dependencies. We're seeing a discernible shift towards friendshoring and regionalization.
Friendshoring, right.
Countries like Mexico, for example, becoming increasingly attractive for manufacturing aiming at the U.S. market. For us, This just means geopolitical risk is now front and center in investment decisions. It's fundamentally altering global trade flows, potentially creating new winners and losers.
That's a powerful point about geopolitical risk becoming such a primary investment factor. With all these moving parts, potential rate cuts, trade realignments, shifting market leadership, what does this all mean for broader market stability and growth prospects, particularly maybe for the U.S. economy?
Well, this immediately makes us wonder about the potential for a U.S. recession. Some analysts, like Doug Peta, are predicting a U.S. recession within the next 2 to 3 months.
Not soon.
That's the call. Citing the exhaustion of fiscal stimulus tailwinds and the accumulating impact of these tariffs we just discussed, this perspective suggests that while we've seen resilience, the underlying economic engine might be losing steam. On a more regional note, the Bank of Korea recently held its policy rate steady at 2.5%. Why? Driven by concerns over a frothy housing market, even though they slightly upgraded their GDP growth forecast to 0.9% for this year.
So local factors matter too.
Hugely. It shows how local factors, even housing bubbles, can influence central bank decisions globally. Meanwhile, political uncertainty in France. Their prime minister negotiating over a confidence vote scheduled for September 8.
Right, that's good.
It's putting French sovereign debt under pressure. Spreads over German bonds are widening. This indicates that political stability, or the lack thereof, can have very real and immediate financial consequences, impacting government borrowing costs and investor confidence across Europe.
A truly complex mosaic of factors indeed. As we look ahead, maybe just wrapping up, what are some of the key economic events we should be paying attention to on our calendars, particularly for those of us following U.S. and European markets?
Okay, based on the information from investing.com, here are some important data points on our economic calendar for today, August 28th, 2025, and upcoming, that we should keep a close eye on. For the United States, initial jobless claims came in at 231,000. That was slightly better than the forecast of 235,000. Suggests a still resilient labor market, though we monitor this weekly, obviously.
Okay.
Continuing jobless claims were 1,970,000, just under the 1,972,000 forecast. Perhaps most significantly, Q2 GDP growth.
The big one.
Yeah, it came in at 3.8%. That was a surprisingly strong positive against a 90.5% forecast. Challenges those recession narratives, at least for now.
Right.
We also have Federal Reserve Governor Waller speaking at 4:00 p.m. U.S. Eastern Time today. His comments are always closely scrutinized for clues on monetary policy.
Always worth listening to a Fed governor.
Absolutely. For the Eurozone, the European Central Bank, ECB, will publish the account of its monetary policy meeting at 7:30 a.m. U.S. Eastern Time. That gives deeper insight into their latest rate decision. And in Japan, we saw Tokyo CPI year-over-year for August came in at 2.9%. The core CPI, excluding fresh food, was 2.5% against a forecast of 2.9%.
So inflation is still sticky there.
A bit, yeah. This data is crucial for understanding inflationary pressures and potential actions from the Bank of Japan, which, as we discussed, directly impacts that USD-JPY pair.
Okay, this deep dive has really shown us that while, yes, specific tech giants like NVIDIA continue to drive significant market narratives and innovation, the broader financial landscape is shaped by this highly complex interplay: macroeconomic shifts, intricate geopolitical tensions, constantly evolving market sentiment.
It's a lot to track.
It really is. Understanding these currents, from AI's real-world applications to the nuanced dynamics of global trade and central bank policies, well, it helps us navigate an increasingly intricate world. It makes us wonder, doesn't it? With all these rapid changes and the constant reevaluation of what constitutes growth, what entirely new picks and shovels industries might be emerging, we're only just beginning to see, especially as AI continues its journey from foundational models to widespread value-generating applications. Something to think about. Thanks for watching. Don't forget to like and subscribe for more insights into the markets that matter most to us.